Podcast is now starting. All attendees are in listen-only mode.
Hi, good afternoon and a warm welcome to all. I am Mridul and on behalf of Care Ratings, welcome you to our today's webinar on India's trade performance. Appreciate your time in joining us for this webinar. To take you further on this, may I introduce our speakers for today. We have with us Kavita Chacko, who is working as senior economist at Care Ratings. Our second speaker for today is Manisha Sachdeva, who is working as associate economist. Our discussion is form of a presentation which is visible on your screen. In case of queries, please key in the questions in the slot provided. We'll be having a Q&A session at the end of the presentation. I repeat, in case of queries, please key in the questions in the slot provided. We'll be having a Q&A session at the end of the presentation. May I request Kavita to begin the session?
Thank you, Mridul. Good afternoon, everybody. In our webinar today, in addition to covering India's trade and its performance, we will also have a look at the various constraints faced by Indian exports and the measures and reforms needed to grow the same. We also examine here if the currency weakness has an impact on exports. To begin with, to put India's trade in the global context, we have a look at global trade performance in recent times. World merchandise trade was $17.7 trillion in 2017, which was 6% lower than in 2014. Global trade growth turned negative in 2015 and 16 for the first time since 2009 in the aftermath of the global financial crisis. The slowdown in world trade in 2015 and 16 can be attributed to subdued global growth, the slowdown and rebalancing of the Chinese economy, fall in global commodity prices, slowdown in investments and capital flows to developing and emerging economies, increased protectionist measures being adopted by countries, and disruption in global value chains. There has been a revival in trade in 2017 and in the current year. Global trade grew by over 10% in 2017, and for the first half of this year, the growth has been 13%. India's share in world exports is very small. It is less than 2% of world trade. There has been only a marginal improvement in the country's share in the last decade. It was 0.7% in 2000, which rose to 1.2% in 2018 and has been stable at 1.7% since 2011. China, in comparison, has a share of 14%, which increased from 7% in 2015. Even though the Indian economy was one of the fastest growing emerging market economies, the country's export growth was negative in 2015 and 16, in line with the contraction in world trade, indicating that the country is not immune to global shocks. In 2017, India's trade grew by over 13%, which was higher than the global growth rate. For the first half of 2018, the growth has been 9%, which is lower than the global growth rate. Now, we look at India's trade performance, especially its exports. Exports account for around 20% of the country's GDP. The country's exports have seen a notable growth in the last decade, having risen from $183 billion in FY8 to $303 billion in FY18, which is a growth of 86%. There has, however, been a continuous decline in India's exports since FY14, when exports totaled $315 billion. India's average merchandise export growth was negative 0.5% during 2014 to 18, compared with the average annual growth of 18% during 2012 to 13. Imports account for around 22% of GDP. The country's imports too have seen a noteworthy growth in the last decade, having grown by 86% from 250 billion in FY8 to 465 billion in FY18. Imports peaked to $490 billion in 2013-14. In case of imports too, there has been a moderation in annual growth rates. Average annual growth rate of imports was negative 0.4% during 2014 to 18 compared with 20% during 2002 to 13. India's trade deficit was $81 billion in 2007-8, which widened to $161 billion in 2017-18, which was, however, $29 billion lower than in 2012-13. A major factor that affects India's exports is global demand. Studies have shown that export growth of developing countries is highly dependent on the economic performance of developed countries and its trading partners. The developing economies enjoy only limited flexibility in using competitive pricing to increase exports. Trade agreements, competitive tariffs, and infrastructure facilities also have a bearing on exports. India's weakening competitiveness is also limiting its export growth. A key feature of India's exports is that it is supply-based and not demand-based. Coming to the impact of rupee on exports, there is a strong economic theory which argues that depreciation of a currency provides a comparative advantage to the country's exports. We tested the hypothesis whether a depreciation in the rupee-dollar exchange rate aids higher export growth. For this, the regression analysis was undertaken to understand the relationship between exchange rate and India's export. India's exports and average rupee-dollar exchange rate for the period November 2013 to October 2018 was analyzed. The year-on-year growth in monthly exports, month-on-month growth in exports, and changes in monthly exports in USD dollar terms were independently regressed with the exchange rate to understand if there exists a relationship between exchange rate and exports. The regression analysis showed that exchange rate has been an insignificant variable in determining India's export growth during this period. We have listed out some of the constraints faced by India's exports which impact its export competitiveness. A major factor is the low share of the country in world trade at less than 2%. To increase it to 5%, exports need to be $885 billion from the current $300 billion. That is an increase of 192%. This is very challenging in the current situation. India's exports have largely been supply-based. That is, items what can be supplied by us and not of items where there is a global demand and we have an advantage and competencies. The shift to demand-based exports is necessary for propelling exports. Logistics and export infrastructure inadequacies is another major impediment. Energy shortages have been one of the major obstacles for the functioning of export units. While India has built airport-related infrastructure, it is lagging behind in seaport-related infrastructure. Port-related infrastructure, which affects trade, needs to be built and upgraded, including the road connectivity. In addition to physical infrastructure, the digital infrastructure too needs to be improved for connectivity inside domestic as well as for the external markets. Improved digital infrastructure would enable manufacturers and exporters to better integrate in global value chains and to expand exports in different market segments. Procedural and documentation bottlenecks is also a factor hindering exports. Multiple compliance requirements, both statutory and administrative, lead to delays and high costs. Despite greater trade facilitation measures in recent years, the time to export and cost of exports are higher in India when compared with China. Higher tariffs too have been a constraining factor. The structure of India's tariff and fee system is complex and lacks transparencies. In order to grow exports, various measures and reforms need to be undertaken. A few have been covered here. Farm exports hold potential. As per some estimates, it could rise from the present $40 billion annually to $100 billion. $100 billion. To achieve that, a focused agri-export policy is needed. Export-oriented farming should be promoted. Currently, any domestic shortage or excess affects agri-exports. There is need to create good infrastructure and marketing for agri-products. Attention needs to be paid to improve packaging and shelf life through better cold storage facilities and improved market strategy. There should be compliance to sanitary conditions of export markets, and affordable credit should be made available to this segment. Backward linkages needed for exports should be strengthened so that issues of pests and disease and pesticide residue in horticulture items are addressed. Procedures for importing of raw materials for value addition needs to be eased among other measures. In other required measures, the ease of doing business for exporters needs to improve. Besides reduction in transaction costs and delay in ports to make Indian exports competitive. There should be streamlining and reduction in procedures and compliance requirements. Customs procedures should be common in all ports, and there should be round-the-clock clearance of exports and imports. Judicial reforms for timely settlement and disposal of litigation too needs to be undertaken. At times, various acts and statutory requirements are interpreted differently at different locations. Hence, there is a need for a one-stop mechanism to resolve export-related problems and disputes within a time frame. Focus should also be laid on enhancing value-added exports. At present, share of high technology exports in India's manufactured exports is less than 10%, whereas this is over 25% in case of China and South Korea and 47% for Singapore. Inbound FDI can play an important role in pushing exports. FDI has played an important role in China's export growth. India needs to pursue this route for export enhancement as it can help in better market access, help secure markets, as well as help in technology and skill upgradation. India also needs to forge beneficial free trade agreements with major countries. It is often stated that our free trade agreements have benefited our trading partners more than us, and some FTAs are just for strategic reasons. Greater involvement by local and state governments while framing and implementing trade policies would also be beneficial. Indian missions have to be proactive in promoting India's exports. Market access issues and non-tariff barriers can be negotiated and tackled by them. Transport and export infrastructure needs significant improvement. In addition to improving infra near ports and road connectivity issues such as congestion at ports, insufficient rakes, high port charges, and high shipping and container freight costs need to be addressed. We shall now take you through the trade performance of the country for the current financial year. I request Manisha to take us through this.
Trade deficit for the 7 months of FY19 reaching a 27-year high of $113 billion. The trade deficit narrowed during the first 7 months of FY14 to FY17, barring FY15, where it grew marginally by 1%. Thereafter, it increased by 68% in FY17 and 24% during FY18. The widening of the trade deficit this year can be attributed to faster rate of growth in imports at 17% compared with 13% growth in the exports during April to October 2018. In addition, the elevated crude oil prices along with the depreciating rupee have contributed to the widening of trade deficit. In terms of exports, for the 7-month period from April to October, there has been a sustained increase in the last 3 years, with growth rate improving from 0.1% in FY17 to 13% in FY19. Likewise, in case of imports, there has been an improvement since FY18. Imports grew from an average of negative 12.5% in FY16 to 17 to 24% in FY18 and 17% in FY19. I will now brief you all about the composition and growth of India's exports and imports. The top 5 commodities that comprise India's export basket currently account for over 62% of its total exports. These commodities include engineering goods, petroleum products, chemical, gems and jewelry, and drugs and pharmaceuticals. Engineering goods have the highest share of 24%, followed by petroleum products at 15%. Gems and jewelry at 13%, and inorganic chemicals at 4%. It is to be noted that barring engineering goods, share of most of these commodities have more or less remained stable since 2010. However, in case of engineering goods, the share has increased from 18% to 24% in the last 8 years. On the other hand, the share of gems and jewelry has seen a decline from 16% to 13% during this period. The growth in exports for the first 7 months of FY19 at 13% was mainly led by higher exports of petroleum products and chemicals. The petroleum products grew by 46% in FY19 over a 14% growth in FY18. This comes at the back of negative growth in this segment during the preceding 2 years. Gems and jewelry has recorded negative growth rates in 4 of the last 5 years. The growth was negative 7% in the first 7 months of FY18 and was negative 2% in the comparable period in the current year. This is notably lower than the 15% growth witnessed in the corresponding period of FY17. Care Ratings expects exports to grow by 10 to 12% in FY19. The top 5 commodities that comprise India's imports currently account for over 70% of its total imports. These commodities include petroleum products, chemicals, engineering goods, gold, and electronic goods. Petroleum products have the highest share of 23%, followed by chemicals at 19%, engineering goods at 12%, and gold at 7%. Although petroleum products form the largest part in the imports, its share has declined from 30% to 23% during FY10 to FY18. Likewise, the share of gold in our total imports has declined from 10% to 7% during this period. On the other hand, there has been an increase in the share of electronic goods from 7% to 12% during this period. Now, the growth in imports at 17% for the first 7 months of FY19 can be ascribed to a significant increase in imports of petroleum products, which has grown by 51% on a year-on-year basis, which is also the highest growth in the last 5 years. This was followed by chemicals, which grew by 24%, the highest growth since FY15. Imports of gold and precious metals, however, declined during April to October compared with the corresponding period last year. Gold imports declined by 3% during FY19 over a 75% growth in the comparable period a year ago, and precious metals imports contracted by 18% over a 44% growth last year. Care Ratings expects imports to grow by 15% in FY19. In terms of destination for our exports, USA has emerged as the top destination for India, contributing 16% in our total exports, followed by UAE and China. The share of USA and China has increased in the India's export, with USA contributing 4% higher in FY19 compared with FY14, and China contributing 1% higher during this period. China is India's largest importing partner, contributing a share of 11% in India's export, followed by USA and Saudi Arabia. China's share in total imports has increased from 11% to 14% during FY14 to FY19. With this, we conclude our presentation. Thank you.
Thank you, Manisha. Dear participants, we will be taking a break of 2 minutes before we come back to take your queries. You are please requested to start keying the questions in the slot provided. I repeat, we'll be taking a break of 2 minutes before we begin our Q&A session. Thank you.
Good afternoon, everybody. We will now start with our Q&A session. We have received a question as to why textile exports have fallen. The main reason for this is India has lost its market share to countries such as Bangladesh, which have duty-free agreements with the US and the EU, which gives them greater access to these markets. Also, they have labor flexibility, which gives them an advantage. There's another question here with regard to India's foreign trade policy. The question is, India's foreign trade policy has set an export target of 900 billion for 2020. Is this attainable? We do not see this as an achievable target, as this would require exports to grow by over 200% from the current level, and this appears to be very, very challenging. Okay. There is a question on what is our outlook on oil prices. Okay. We had earlier projected oil prices to be around $70 per barrel. Okay, given that the recent declines following the waiver of Iran's sanctions, there has been a fall in oil prices. However, we need to see if this decline sustains. The only clinching factor would be the announcement at the OPEC meeting to be held today on the production cuts. We have to wait and see what the outcome of this would be in the next few days before we can make a reasonable estimate for oil prices for the coming future.
Now we have another question that why have imports of gold and precious metals have seen a decline? Gems and jewelry sector has been plagued by various scandals and lingering effect of demonetization, as orders which were lost during the period of demonetization have not been regained fully. Also, the delayed GST refunds, which have led to funding issues, have also impacted this sector. Um, we have another question. What will be the likely impact on import bill post March 2019 when the waiver of import cuts from Iran come to an end? Now, this will depend upon the trajectory of the crude oil prices going ahead. As such, it would be premature to make a call on the impact as of now. There are various factors that could influence prices in the interim, such as outcome of the OPEC meeting and whether there would be production cuts by oil producers. Also, it needs to be seen whether any extension would be given beyond March 2019. And at the same time, given that the oil markets have adequate supplies, the impact on prices may not be too severe even if the cuts are not extended.
Uh, we have another question here. If in Does India stand to gain from the trade conflicts between US and China? We feel that the gains here could be limited because our export competitiveness is low. We would really need to improve on this to take advantage of uh, whatever market share we can gain from these conflicts between the two countries. We have another question as to where do we see the US dollar against the INR in March 19? Uh, we have made a projection for the USD to INR exchange rate to be around 70 rupees per dollar for the near term. However, making a projection for up to March will depend on various factors which could develop during the interim. One of them could be the developments on the crude oil front, and we have seen that in the recent past the depreciation in the rupee was to a large extent triggered by the rise in crude oil prices, and the strengthening which we have seen in the recent days is also to a large extent on account of the moderation in prices in crude oil. Given that the crude oil prices continue to remain volatile and would to a large extent be driven by the decisions of OPEC at their meeting together along with their other producers with regard to the production cuts, we will have to look for the outcome of this meeting as well as the movement in crude oil prices over the next few days to come up with a proper assessment as to what the likely level of the rupee would be as of March 18. But for up to December or so, we expect it to be in the range of 70 per USD.
I think there are no more questions coming in, so we'll be ending this session. There's a query from Mr. Sunil Parekh is asking that I think so you have missed the 5 minutes of the initial presentation. What I'll do is I'll send you a uploaded link on YouTube, so you can have a reference of all, the entire webinar. Thanks again for taking your time out and being a part of this Care Ratings webinar. We hope the discussion was insightful, and we really look forward to your participation in future also. For any further queries or any more questions, you can please write to us at corp.com@kratings.com. The ID would be coming in the suggestion box no sooner the webinar ends. Thank you and goodbye for now.